So today we are going to do a consolidated worksheet. So we're going to work through a comprehensive consolidated worksheet problem. So first we're going to start with, I'm going to read the problem, but I'm also going to make it a little bigger so it's easier to see on the screen. Make this a little bigger. So this is from Advanced Accounting. Following are the account balances of Miller and Richmond Company as of December 31st. The fair values of Richmond's company's assets and liabilities are also listed. Additional information not reflected in the preceding figures. So the figures are below to make it easier to make values, but we're going to say on December 31st, Miller used 50,000 shares of its $20 par value common stock for all outstanding shares of Richmond Company. As part of the acquisition agreement, Miller agrees to pay the former owners of Richmond $250,000 if certain projections are realized over the next 3 years. Miller calculates this acquisition date fair value of this contingency at $100,000. In creating this combination, Miller also pays $10,000 in stock issuance costs and $20,000 in accounting and legal fees. So, required. So A, Miller's stock has a fair value of $32 per share. Using the acquisition method, number 1, prepare the necessary journal entries if Miller is to dissolve Richmond so it no longer has a separate legal entity. And number 2, assume that Richmond retains a separate legal entity, a legal incorporation, and its own accounting system. Prepare a consolidated worksheet. Okay, so I just talked a lot about a bunch of information, but let's go over the book values of both companies on the date of acquisition. So we have Miller Company, which book value is $600,000 in cash, $900,000 in receivables, $1,100,000 in inventory, and $9 million in buildings and equipment net. They don't have unpatented technology or in-process development. They have accounts payable, and they list all their liabilities as a negative number in here. That's just how the book sets up the problem. They have notes payable of $3,400,000 for a total of $7,800,000. They have common stock $20 par value. They have Richmond has a common stock with a $5 par value. The additional paid in capital for Miller is $900,000. Retained earnings on 1/1 is $2,300,000. Revenues and expenses. Revenues are $6 million. Expenses are $3,400,000, and that totals $7,800,000. Next, you have Richmond. So cash, these are the cash book values on the balance sheet, and then we have fair values. So Richmond has fair values on date of acquisition because there could be fair value differences. So the very first thing I would want to do when I set up this consolidated, to calculate either whether we consolidate or we just make journal entries to add their assets and liabilities, is to calculate the fair value book value differences. So I am going to do fair value minus book value. Okay. So the fair value, and I'm going to add this up some. So there's fair value and book value differences. So it's actually valued at less money for the receivables because some of them probably aren't collectible. There's inventory. There's an increase in actual fair value. There's an increase in buildings. Then we have unpatented technology and in-process development. And there's no differences in the liabilities for a total fair value difference of $910,000. So now that I've calculated the fair value differences, I'm going to write down the given information from the problem. This is how I always start my problems. That way I may use this information, I may not when I calculate. So we know that common stock shares are 50,000. So they issued 50,000 shares to buy this. So, oops, put an extra 0. That's why I always format my numbers. And we know that the par value of that stock is $20 per share, right? And the fair value on the date, fair value of stock, Miller, is $32. This is just information that I read from the problem. We also know that Miller is offering a contingent liability fair value, fair market value, they said was $100,000. Now the contingent liability is $250, but the likelihood of paying brings the fair value down to $100,000. So, all right. And then we had stock issuance cost of 10,000, and accounting and legal fees 20,000. Okay. So now I've put down the given information. I'm going to do step 1, calculate purchase price. So, how am I going to do this? I'm going to take the par number of shares issued, right, which was 50,000, and I'm going to multiply that by fair market value of shares equals total value of shares, and I'm going to multiply these two. So the other thing we'll need to do is separate this if we're going to make a journal entry. So common stock would be this times this, right? So we're going to separate this out, because if we're going to make a journal entry, some of it goes to common stock, which is the par value, right? And then additional paid in capital equals fair value minus par times the number of shares you issued. So, and then we have a contingent liability. So that's all part of the purchase price. Liability equals 100,000. So total purchase price equals purchase price, there we go. So the total purchase price that they paid to acquire all of Richmond is $1,700,000. Step 2, calculate book value of sub. In this case, it's Richmond, or our subsidiary. So we are going to take total assets, and this is from the book value. So our total assets equals the sum of all of the assets listed up here. Right there. Oh, so that's fair value. Sorry. Equals sum book value of Richmond right there. And our total liabilities sum of these two numbers. So book value, net book value of Richmond. And we're going to add these two numbers together because the liabilities are listed as a negative number. So the net book value is 600,000. This was step 2, by the way. Now we're going to go to step 3. Calculate excess. So we take the purchase price, which we already calculated in step 1, less net book value put a negative sign, and excess, which is excess we paid book over book value, is 1.1 million. Okay, so we got that. Now, step 4, allocate excess. First, we're going to do it to fair value differences. So since I already put this in Excel, I'm going to copy all these ones that have differences. I'm going to copy their names. So it's right here. I'm just going to copy and paste those names down here. Oops, I pressed something. So again, I'm going back up here. Copy. I'm pasting the names, anything that had a fair value difference. And then I'm going to copy and paste the values. Right. Okay. Total allocated to assets equals and then to calculate goodwill, it's our excess minus whatever we could allocate to assets that we could identify, assets and liabilities. So our goodwill is 190,000. So part 1 of this problem. So now we've made these calculations so that we can go to question 1. Prepare the necessary journal entries if Miller dissolves Richmond so it is no longer a separate legal entity. So we need to do all these steps in order to be able to prepare the journal entry. So the journal entry is going to record the purchase. So our journal entry to record purchase so we're going to take cash and we're taking fair values. Cash. I'm going to copy to save myself time, right? Apparently I'm not good at copying and pasting. I'm just copying all the assets for now. Okay. So I'm going to take all of their assets at fair value. So I'm just linking the numbers. I'm taking buildings and equipment fair value, inventory fair value, unpatented technology. Nope, I might have copied this wrong. Sorry. Forgot receivables here. That's what happens when you copy paste. I'm going to delete these. So receivables is 290 from fair value. Inventory, I'm just going to go one by one, is 820. Buildings net fair value is 900,000. Unpatented technology is 500,000. In process R&D, and then the other asset we would need to add as part of our purchase price is goodwill. So goodwill, which we calculated. So these are all the assets that we're going to write on. Now we are going to take on accounts payable, which we're taking from the fair value. It's in a negative number, so we wouldn't make a negative number in a journal entry. That just means it's on the credit side. So I'm going to make sure it's a positive number here. We got accounts payable. We have notes payable. Right? Then we have the stock that we issued to buy the company in step 1. Common stock, 1 million. Additional paid in capital, also known as APIC. And so we calculated this in step 1. Additional paid in capital. And then finally the contingent liability. Which is 100,000. So check my journal entry is right. We need it to balance. Equals sum. So it is correct. So that's our first journal entry to record the purchase. Then we need a journal entry stock issuance cost, a journal entry to issue stock issuance costs. So stock issuance cost reduce additional paid in capital. So we took this information from here. They had stock issuance cost of 10,000 and they had to pay out cash. We assume they paid cash for these stock issuance costs of 10,000. And then our final journal entry for legal and accounting fees is accounting and legal expense, which was 20,000 from the problem. And the opposite side of that, oops, gosh, is cash. So that is part 1 dissolves. So this is if the other company doesn't exist after the merger, after the acquisition, really. So the next question is, what if you were to retain separate legal entities? What would we do differently? So the problem remains the same. All the information remains the same. We're going to do part 2, separate entity. Okay. So I'm going to make this screen bigger so it's easier to watch. So journal entry if separate legal entity. So on the journal entry, the purchase price is still the same. right? So all this information that I calculated over here is still the same. It's just that we're going to make separate journal entries. They're not going to, and then we're going to consolidate the worksheet. So to record the investment, we would make a journal entry and it would say investment in Richmond, right? And it would be for 1,700,000, which is the purchase price. And then we would record the common stock from problem 1, which is 1,000,000. Additional paid in capital, which was 600,000. And the contingent liability, which was 100,000. We would also record the stock issuance cost, which would be additional paid in capital. I'm going to go down here. It's going to be the same journal entry, right? Additional paid in capital and cash. And then to record legal and accounting fees. Okay. And that would be accounting and legal expenses, 20,000. And we're going to credit cash 20,000. So these would be the journal entries. Then what we would need to do is after the date, we would need to consolidate their financial statements. So I am going to copy and paste all of this. Copy and paste. Okay. So all I did was copy and paste the information from the previous problem, because now we're going to have to consolidate year-end financials. We don't make journal entries to write on their assets because they're separately going to maintain books. So what we are going to do is make consolidated entries. So our first consolidation entry, A. This is fair value differences. So before we make the consolidation journal entry, we need to actually adjust the balances for things that happened at the acquisition. So we need to put on these journal entries. So what I'm going to do is, as you can see, there's no investment account. So I'm going to make above buildings and equipment, I'm going to write on the investment in Richmond. And this is going to go on Miller's. I made a typo here. Miller's books, right? So our investment in Richmond is going to be 170,000, 1,700,000. And we are going to increase our common stock because remember, we issued common stock. So these are negative numbers, so I'm going to subtract the 1 million in common stock that we issued. Right? And I am going to increase, so at this point I've taken care of this one and this one. I'm highlighting this for you. Now we got to do additional paid in capital. So I'm going to go down to Miller's book values, additional paid in capital, It's a negative number, so to add to it, I would put another negative number, right? And then, so now we've adjusted for this. Now we're going to adjust for the contingent liability, which would be, we would just add this above notes payable. So contingent liability. So remember, it's a negative number because it's a credit. So we're going to add that 100,000. All right, now we're going to do, I'm going to make sure the totals are right. Yep. And now we're going to adjust for the stock issuance cost. So we're going to, since this is a credit to stock issuance costs, we're going to add it because these are negative numbers. So additional paid in capital should be 1,490,000. And then, so we got this. We're going to have to adjust the cash balance. So equals, and this is going to subtract from cash because we're taking away cash. So we've recorded this one. Now we just have accounting and legal expenses. So the expenses would go down to this expense line. So I'm going to hit equals this expense plus the extra 20,000 that we spent on the merger. Right? And then we're going to adjust cash again. We're going to subtract the other 20,000. So once we're done making these adjustments, technically these totals should balance. If they didn't, I made the adjustments wrong. So now we have adjusted the starting balances for the purchase of the investment. Now we're going to make consolidation entry. So consolidation entry A is fair value differences. So we're going to have to calculate everything from the first page that had fair value differences. So the first thing we have is receivables with a fair value difference. Now receivables is a negative number, so that can't go here. So once I see that it's a negative, we can't make a negative journal entry. A negative receivables would basically mean we need to credit receivables. So I'm going to change it to a positive number, and I'm going to credit receivables for 10,000. Yes, sorry. Equals negative 10,000. Does not like that. Okay. Okay, so we're going to credit receivables. And all I'm doing is taking the fair value differences from the last one. Then we had inventory. And I'm taking the fair value difference, 220. Then we had buildings and equipment net. And we're taking the fair value difference. And then we have unpatented technology. We're taking the fair value difference. Oops. Equals fair value difference. Unpatented technology in process. R&D, research and development, 100,000. And we also need to take the goodwill, because this is part of the fair value differences. So I'm going to go to our goodwill calculation. And the other side of this, we would, this is really a credit, right? So I'm going to move that over. We would credit investment in Richmond, which equals the sum of all of these minus the credit that we already have. If you look, this should tie to the book value, the excess number. This ties to the excess. So consolidation entry A would reduce the investment account by the excess if you do it correctly. So that's my check. Okay. So now what I'm going to do is I'm going to go up here and I'm going to do entry A. Okay. And so this is a negative number to receivables, right? This is inventory. This is buildings. Oh, investment enrichment. This is a negative number because it's on the credit side. Then we have buildings, unpatented technology, in-process R&D, and we need to add goodwill. Goodwill. So, all right. Now we're going to make consolidation entry S. So we need to eliminate the common stock of our subsidiary because technically it doesn't exist because we own all of Richmond. They're just keeping the stock on their books, but when we consolidate, they won't have any common stock value. So what you're going to do is, if it's a credit balance, you're going to debit the common stock. You're going to debit additional paid in capital. You're going to debit retained earnings because you own their retained earnings. You're going to debit revenue. Change the negative sign. And we're going to credit expenses. And we're going to credit investment in Richmond. And it should equal all of these minus this. And that this number should tie to book value that you calculated in problem 1. If it doesn't, we did it wrong. And now we're going to put this into entry S. Okay. So entry S. Let's see what we got going on here. So we're going to So this is, since it's in a negative form, the positive will subtract from it. We're going to do additional paid in capital. We're going to do retained earnings. We're going to do revenue. We're going to do expenses, but that's going to be a negative number because it's a credit right here. And then we're going to do 600,000 to the investment account. So we're going to subtract the investment account. Okay. So then we're going to get to a column consolidated balance. Okay? So we are going to add across, since we already put these in negative numbers. So I'm going to go down till here. Right? And then what I'm going to do is do an auto sum of that. Right? And then I'm going to add across again. And then I'm going to sum this all up. And it should equate. So even if I separate this so you can see, basically we have the total of our assets and liabilities netted together and our equity account. So these two numbers total, these are our consolidated totals for this worksheet. And that's a comprehensive consolidated worksheet on date of acquisition. Of course, it's not always date of acquisition, but this entire chapter is date of acquisition. So this is part one was what if it dissolves and the company doesn't remain Richmond, and number two is what if it remains a separate legal entity. So this is how we would make a consolidated worksheet. I'll post Excel inside our course.